Hey guys, this is Simon with Trade and Perform Coaching, and wanted to go through and explain a very basic concept or idea that's important to understand for where to find your high odds trades. So we have all these algos kind of working through day over day, and I want you to understand the importance of getting above or below the wave to the low, right? So when you see the waves on the bottom of my screen, I'm going to use CL, NQ, and ES as an example in this video. It it doesn't much matter. Um, it doesn't much matter what product you're trading. In order to, the whole concept is, so let me slow it down a step, right? What everyone is looking for, right? Um, when traders are stuck, they provide liquidity because they have to get out of their trade, right? So it's a very simple concept. I'm going to move this up and explain it. If the market's moving up, right, we're looking for ways to figure out, and it follows this pattern like this: up, down, kind of up, maybe down a little bit, up some more, down some more, up some more, right? Well, as the market's moving up, right, just gauge your own emotions. Let's say you in fantasy land took the trade over here, and you're just really happy that you're making money, right? So you're the smart trader, you entered over here. But as the market's going up, it's going to pile in more and more traders because everyone always has this kind of FOMO idea that the market's just going to go vertical straight up and never come back. And it does sometimes, right? So it's not a totally founded idea. There's examples where that's happened, but 99% of the time that doesn't happen, and particularly intraday, right? So as the market's moving up, each of these waves up have buyers in them, right? And obviously the buyers were more motivated than the sellers because they kept pushing price. So as you're pushing up, right, you end up with this kind of last push up. And so the question becomes, how do you know when you've trapped buyers? Because those buyers are going to provide sell pressure to the downside once they get underneath them. So the idea is if this is the last wave up, right, once you've closed underneath that wave, usually the market's going to come down, you've closed underneath that wave. Hopefully, at least in my case, they're going to push back up and test, and then they're going to continue to push to the downside. And then the opposite is true for sellers. All right, so I'll show you. As the market is pushing down, all right, so you have the market come up, right? This is going to be kind of like, kind of makes this final push, and this becomes the bottom of that final push, right? So the market comes down, gets underneath, hopefully comes back up to test, gets resistance, and then closes underneath again. Sometimes it just, so your options are to either just go straight down or it comes back up, finds sellers and pushes back out. This is the model, the ideal model that you're looking for the price to emulate, right? So the advantage is that once you get underneath here, right, you have some boundaries. Like just like in life, we need boundaries to operate, right? In order to drive a car in a city, we need to know that the traffic that's coming from the other direction is going to stop if there's a red light, right? We have to have a good idea. Now we all know that traffic, someone in that opposite lane may not stop, right? But most of the time, 99% of the time, they do. That's how we function as a society, right? We know that certain rules and ideas will be followed and are repeatable, right? So we know that once we close underneath here, if we don't get back above the top of this, whoever the buyers were in this group are trapped, and vice versa for the sellers. Once you have buyers trapped, you get underneath them, what they're going to do is go, hey, I want to get out of this trade. I thought it was going higher. It went lower, and get me out. So now we're going to go and translate that idea into, charts and see how that looks on charts, right? And keep in mind, right, someone might say, well, that's one of the objections to the idea or the concept is that the stop is too large when you do something like this. That it's too big, it costs too much money. Where you enter the trade doesn't matter at this particular stage of learning, right? And that's what we're doing here is we're learning. What matters is, look, if I get this, extended move to the downside like this. Give me just a second, make sure my wife's not trying to reach out to me. Okay. And once I've got these guys trapped, right, once I'm underneath this line right here, what I have is a boundary, right? And that boundary says if I don't get above here, we're most likely going lower. Just like when you're approaching a stoplight and it's red, you're probably going to stop. Most people are probably going to stop at that red light. You could bet money, right? If you have 100 cars come to a red light, odds are 98 of them are going to come to a complete stop. Most of them are not going to run. A very small percentage of them are going to willfully run that red light every single time, right? So it's the same idea here. So take that, and now let's go find that in real life. And I'm going to use Friday as an example. This is the most recent PA. Here, let's reset this really quick. Okay. And let's get earlier than this. Let's go around 7:30. $6:45, somewhere in here. But see when this is pushing down? So the market goes up, right? So the market's coming down like this. See this? Over here to the left, the market's been pushing down. You can see that over here, right? And it finally makes this push all the way down into the low. This is the low right here. That means the top of this wave and the bottom of this wave, right? That's where all your sellers are trapped, right? And I can see once I close above that wave, I can think to myself now, hey, I've got a boundary. I know as long as I don't get underneath here, that I am likely, not 100%, but I'm likely to get a push out from there, right? And I can start looking for trading opportunities if that occurs. So you'll see we pushed out, right? And I could have bought here and put my stop underneath here and been just fine. If you look over to the right, it pushes out significantly from that location. The best I would have done if I had simply bought here, which is what I describe as an orthodox close above, 63.13 to 63.75. I think maybe even a little bit higher. Let's see. No, not higher. 63.75 was it. And this is 8:19, by the way, so it may not be Friday, may have been Wednesday. It doesn't really matter. The whole point is I get above that wave to the low, and now I know that sellers are trapped there. And now I can start figuring out how much leverage I can use, how I want to enter that trade, but I have a clear boundary and perspective for how I want to operate. Let me give an analogy to that. You may see a red light from 500 yards away, right? One driver might keep their foot on the gas and brake at the last minute. Another driver might take their foot off the gas and just coast. And the third driver might start putting their foot on the brake 500 yards away or however many miles away you want to use for the example. But the point is that all three of them most likely will come to a stop by the time they get to that red light. But all three of them may have a different method for entering, depending on how aggressively they drive, their risk profile, their driving style, all kinds of things will go into that calculation. But all of them, when they get to that red light, will most likely have come to a complete stop. Most people don't want to run a red light, right? So you may have entered here. I may have entered back all the way over here. You might use just a little bit of leverage. I might use a ton of leverage. I don't care. It doesn't bother me. Either way, however you think about it, that's your business. All I know is as long as it doesn't get behind here, I have very good odds of pushing this trade out and making good money, right? Now go to the other side of that trade, right? We come over here, and now I'm looking to get underneath a push to the high. The only thing I require to define a push to the high is that there's some type of V-shape component to it, like this. Push down, push up. Now I need to get a clean close underneath here. I don't want this component where there's no downside rotation. So this is my push to the high. I have to get underneath. This becomes my push to the high. I need a complete orthodox close underneath here. I never get it, right? This is a fresh push to the high right here. I would draw it like this, right? That's what I need to get underneath. And then if I want to see, once I get above here, okay, so see how that becomes my push to the high? This move right here. So again, it sets a boundary for me. If I get underneath this bar, that means this is the orthodox close underneath. Now, I may not know how it's going to go lower, right? It could have quite easily just come back up and tested like this and then gone lower. But what I know is I'm very likely to get a trade that'll work to the downside from that point. And my stop needs to go above here. Now, that's the most basic of explanations, and the algos help us significantly in figuring out where we can capture those trades to the downside much more easily, right? And then you'll see over here at 950, see how this becomes the push to the low right here, pushed up, push back down. I get above, right? Get above, pushes out. This should become support into the downside, and off it goes, right? So again, if I bought here, I put my stop down here, I have very good odds of getting a profitable trade in my favor. That idea or that concept is so basic in my trading and in my thinking that everything I do surrounds that idea. Everything I do surrounds that concept. That's how I make money trading. And all these algos give me an edge within that idea or that concept, right? And I'm not showing a lot of that here in this video because the idea was just to make it as simple as possible. So the advantage to all of this, right, and I'm going to show you here with NQ before I go through that. Here's NQ, same concept. This is from the 20th, Friday, right? So seeing to this 10 a.m. low, we get a push to the downside, right? We get another push to the downside. So this becomes my move to the bottom. We don't get above it. Then I get a new push to the bottom. So that's my push to the low. I want to get above it. I get above that here, right? So I know when I get to this bar, when I get that close above, that if I don't get this close below, I have extremely good odds of pushing out on that trade. I'm going to show you the push to the high, and this is actually a short that we caught in the room. So you can see the pushing up here, push to the high, we don't get underneath. Comes down, here's the next push to the high, right? So I know I never get above that. Again, orthodox close underneath, little backside test, and again, push to the downside. So that repeats. So why is that important? That's important because it puts boundaries in your trading and in your thinking. It doesn't all seem wide open. You actually start to get a very good balance of where buyers and sellers are trapped. And that is why the waves or the rotations, however you want to call them, are very, very important. And that is a cornerstone of our thinking. I tell people in the room every single day, if you'll wait to get underneath the wave, right? And we actually have a way to break up those waves to find out even more information within them. But if you'll wait, even if you don't have that information, if you'll wait to get underneath the waves to the high or the waves to the low before you start initiating your trade, and you put your stop behind that wave, your odds of finding a winning trade go up astronomically. It's 100%? No, that would be bullshit. No one in trading makes 100%. But that tells you that the momentum is shifted, that the likelihood of it going the other direction or lower are very high, and that it's likely to do it in pretty short order, right? So, and what you're really hoping for is once you get underneath these waves, is that it'll do you the courtesy of pushing back into them, so that since your stop is at a fixed point, has to be on a close behind here, the further you push in, the more leverage you can add to that short for the push down. But that's a different problem to tackle. So that's today's lesson. It's Sunday, the 22nd of June. If you have any questions of me, if you would like to come visit the room, if you don't understand something that I put in the video, come visit us in the room. Ask for a pass to the room. It's very simple. Trade and Perform, TRADENPERFORM. simon@gmail.com. My name is Simon. I'm happy to pass on a 3-day pass to you. The money that we make in the room is really impressive. New people and older traders really benefiting from the algorithms and from just a basic understanding of which way the market's about to turn. Really gives you just a huge edge in being able to stay profitable. I hope everyone's having a great weekend. I'm going back to enjoy my family time, and I will talk to everyone tomorrow morning. See you guys. Bye.